Hey guys, welcome back. This is Toby Mathis, and we are in part 2 of our series on estate planning, and specifically the 11 steps towards creating a great estate plan for wealthy individuals. All right, in this particular section, we're going to start off on part 5, or step 5, which is really we're talking about things that have to do with business and succession planning. So we're in part 2, which is things you do during your lifetime. And step 5 in the estate planning process is planning for business continuity. And here's the big things to think about. Number 1, who is going to run my business if something happens to me? If I'm a doctor practice, lawyer, engineering, something that requires a license, architecture, etc., one of the best things you can do is set up with somebody either in your office or a competitor or something else to have them acquire your practice if something happens to you, rather than leaving that burden onto family members as you go on. So in my case, for example, I'm an attorney. One of the simplest things an attorney in a firm can do is say to the firm, buy me out when I pass away. And people immediately are going to say, well, how are they going to buy you out? You're missing, right? Remember this life here? Remember this? Me as a person? I can insure it. That's usually what you do, is you do a buy-sell agreement with your partners that has an insurance component, so that if one of you dies, there's cash there to buy out the surviving, to pay off the surviving spouse or family members, or to the estate. Whatever the case, I do not want to have partners in my business that I didn't choose. Like, I don't want my partner's, no offense, but I may not want my partner's spouse, or I may not want my partner's kids to become my partners, right? So I may be in business with somebody and just find out that, hey, I do not want to have their spouse be my business partner, or perhaps they can't because they don't have the licensing. So have a business succession plan in place before something happens. What if I become incapacitated? Then I could still have a disability policy that immediately pays off or buys out my interest. What if I don't have business partners? And you say, hey, well, great, Toby, but I don't have business partners I could sell to. Great, find a key employee or a competitor. So for example, if you're a doctor in a practice, you might find a competitive practice and say, hey, I'll buy your practice, you buy mine. I want my customers or my patients to be honored and maintained, and I don't want you to have to come out of pocket. So why don't we do this? You buy a policy on me, I buy a policy on you, or however, work with your insurance company. They have programs designed for this sort of thing, where you can come in and say, all right, I want to make sure that I'm funding it, but it's triggered off of the passing of somebody. So you guys both might be paying a small amount for the insurance on each other. And it can even be term. It doesn't have to be, because we're talking about something that either I'm going to sell that business or I'm going to retire from that business. What I really care about is if I'm like, let's say you're in the 50 to 75 range, you want to make sure that you have something there. So if something happens to you unexpectedly and you're not retired yet, that your business doesn't suffer, your partners don't suffer. If you don't have partners, that your business and all your employees don't suffer. You don't find out that you're in a shutdown and put behind the 8 ball because you didn't plan. So make sure that you have business continuity. Get a buy-sell agreement when it's appropriate, when it's necessary, and make sure that you have those things planned ahead of time. One things that we do, I'll just tell you this, when I put together an LLC, for example, I'm always going to put in there that if you have a partners, if you're in an LLC and something happens to one of them, the remaining members get to decide whether they're bringing that person in with management rights. And that way you're not forcing something onto somebody. But again, you can very easily document this stuff ahead of time. Number 2, or number 6, this is number 2 of this section, but number 6 of our 11 steps, right, is to prepare an heir or hire a trustee, or prepare to hire a trustee for specific activities. So for example, if I have an estate and I'm a real estate investor and I have stock investing, make sure that one of my heirs knows what I'm doing. I just had this happen. Somebody passed away. They were an active trader. They have a whole bunch of spread positions open. They have a bunch of active trading, and nobody knows what to do with it. Like the spouse and their kids are literally looking at it like, we don't know what dad was doing. passed away unexpectedly, and all of a sudden they're forced into that scenario. Make sure that you're letting somebody know. And if you don't have a person that's your heir that knows, make sure that somebody in a decision-making capacity or that's working with your trustee has that expertise. So for example, in a trust, you might put, hey, my spouse and so-and-so, or a company. Let's say that I have a banking relationship and they have a trust department. And that's where I have my brokerage account, or if I'm in brokerage services, I am making clear to either an heir or my spouse, this is the individual I work with, so that if something happens, worst case scenario, they can hire that individual to close out the position so they can communicate directly with them. Or you have them come in as a joint trustee, and you might say, hey, that this person is a co-trustee with my surviving spouse, so long as he wants it, right? You could actually make it to where you're just saying, hey, my recommendation, or only so long as a grantor who's also a trustee wants it. You could have it to where they could remove them. It's easy to get rid of them, but you're putting them right there and you're letting them know this is what I'm doing, so that if something happens to you, that you have somebody designated with the expertise of what's going on to handle it. If you're in business, and I have real estate investing, for example, it may be something that your spouse has nothing to do with. Or if you're not married and you don't have a significant other, maybe it's something where it's just kids, or you're leaving it to other organizations. Make sure you're bringing somebody up to speed of what you're doing, and then have that conversation. Hey, if something happens to me, I want to make sure you're stepping in and either handling these assets for the benefit of my beneficiaries, or that you're liquidating out my assets, however you direct it. Make sure your wishes are known. Hey, I'm doing a series of private placements and I'm constantly investing in private placements. Make sure somebody knows what you're doing, and that person has a position of authority, or that your position of authority, the person who's another trustee, knows about that individual, so that they can pick up the phone. I can't tell you how many times it happens in our firm where somebody passes and I get a phone call from either the surviving spouse or the heirs, or somebody trying to figure out what's going on because somebody didn't leave a good blueprint of what's actually taking place. It's very easy to bring them up to speed once you know, okay, this is a scenario. Or better yet, I love it when a spouse says, here's my blueprint. I want to make sure my kids understand it. I want to make sure my spouse understands it. And you have that conversation. And then if something happens, it's easy peasy to make sure things are handled. Because remember, we have everything in the luggage. All we have is somebody who's been designated to decide when to take things out, but you also still have to manage those business assets. And it's easy when you have a system of entities where, for example, in the case that I did in part one, I had a holding entity for my real estate. It's really easy. That manager can manage everything down below it. They can literally control everything on down. So it becomes really easy to say, here's the heir, here's my spouse, whoever it is, this is the person that really understands it. Maybe it's a business partner, and you say, this is the person that's managing that asset. When the money comes in, it's going into my suitcase, and I have designated a trustee. Maybe it's my surviving spouse, maybe it's heirs, maybe it's a third party, maybe it's a bank, whoever it is. I have somebody designated who can go in there and then distribute the monies out according to the express wishes of that trust. It becomes really, really simple. So again, single person, pass away, heirs, I designate, here's the party that knows what's going on the business side. Here's the party that knows what's going on with my family and making sure that things get distributed out. Make sure those people are designated. And if you do that, you'll be really, really well off. Now, I've been talking a lot about using trust. And so let me just talk about number 7 is making sure you have a trust or a series of trusts. It could be one or more. If it's one, more than likely you're just using a living trust. I just have a revocable living trust. I can change it anytime I want. It has written instructions. If something happens to me, either incapacity, disabled, I'm not able to act on my own behalf, or I pass away, that trust snaps in and covers things. Even during my lifetime, it's called an inter vivos trust, because I can revoke it at any time and make any changes. I'm in charge of everything. If you're married, it's you and a spouse, typically. And if something happens to me, I have that spouse designated. Something happens to me and that spouse, I have successor trustees designated, and we'll talk about trustees next. But I have a document that is easy to change and that controls things. Now, if I want to get certain assets outside of my estate and protect them, I might use something called an asset protection trust. A Nevada asset protection trust is probably the king. And all you're doing is you're saying, hey, I'm taking assets outside of my estate. Remember, control, not ownership. But I have to have a third-party trustee manage those if I do not want it included in my estate. And I have to give up certain amounts of control to make sure that it doesn't flow back to me and is not includable in my estate. Now, I could still set it up. It's called an intentionally defective grantor trust, meaning that, hey, it's an irrevocable trust. It's good for asset protection. It's good even for my estate planning to keep it out of my estate and let the growth, grow over here on the trust. Maybe I have beneficiaries that's my then spouse and then my descendants. And literally, that's what you'd put in there. You wouldn't even put their name. You just say my then spouse in case you get divorced, right? You want to make sure that you have something. If I'm putting it in place, or if you're married, you might say each set up one with my then spouse and then descendants. But you could have something like that set up that is transparent from a tax standpoint. I don't have to do a return for it, but still effective for my estate. Now, if I want to take it the next step and say, not only do I not want it in my estate, but I don't want it on my tax return, in which case you'd actually be setting up a separate non-grantor trust. You have two flavors, simple or complex, topic for a different day, but you're actually creating beneficiaries now. Now, where does that oftentimes get used? If I have a highly appreciated asset, like I have a business and I'm going to sell that business, quite often somebody will set up a trust for their kids. They will sell the asset to that trust. They cannot be a trustee. They cannot be, when I say they, the person who is owning the business, you cannot be a trustee. You cannot be in control of that asset. But I'll set up an installment sale over a period of years to spread out the tax, but it enables that trust to eventually sell that business and have a stepped up basis of whatever it paid for it. So if I have a business and it's worth $20 million and I'm worried as heck about the estate tax coming in and hitting me and my spouse, because right now it's 12.06 per spouse. So 24,120 is what it is as I'm standing here today, 24,120,000 between two spouses. If I'm pushing that line and I say, oh, you know what, I want to make sure that I don't cross over and get hit with that 40% tax plus my estate tax. I want to make sure that I don't crush my estate with taxes. I might sell that to freeze it, take back a note that spreads out the tax hit over a long period of time, knowing that if we sell it for $30 million, at some point the only taxable amount that's going to be allocated to my heirs would be the extra $10 million of growth. Or better yet, it's worth 20 some million. I sell it to myself or sell it to the trust and take back a note for 20 million and it's worth 22 million later, then you only have the 2 million. Or if it hasn't changed in value, then there's no tax. And what I did is I transferred the asset over into this category. So now I don't have to worry about having it included in my estate. I still have the income stream. I still have the installment sale that's going to be part of there, but all that extra growth from that point forward, or if those assets continue to grow, not part of my estate. But that requires that I set up an irrevocable trust that's either a complex or a simple trust. It's either distributing the income every year or it's not. And it's either I can distribute just the income and not touch principal, or I can distribute principal and income or neither, which is a complex trust. So like I have choices of flavors of what I do, but I definitely need to be looking at using those vehicles if that's my situation. So a living trust at a minimum, possibly a Nevada asset protection trust, possibly a trust for other purposes. That's a irrevocable trust. That's a complex or simple trust for heirs to get things out of my estate. Whatever the case, it's still just a trust. It's a grantor, trustee, and beneficiary. There's other flavors like charitable annuity trust, charitable lead trust, charitable remainder trust, irrevocable life insurance trust. I mean, there's just so many different types of trust. Just know that that's where you're going when you get over that $20 million mark. That's really what you should be looking at. Anybody of any value who wants to have an estate plan, especially wants to leave a legacy, a living trust is the appropriate tool. All right, number 8, 8th step, make sure that your trustees are prepared. So if you have a situation in your family where you have children and you feel comfortable with those children having some management rights over an asset, you may, and I say this really gingerly because I really don't like kids sitting in as a trustee unless there's someone to keep them in check, but you may have them as a trustee. If you're married, it's going to be you and a spouse. During your lifetime, it's you and a spouse, period. It's going to be you and your spouse as the trustees. One of you passes, the survivor remains the trustee. The only question is whether you add another trustee for them to work with. If both of you pass, then it's really up to you as to whether you use a company, whether you use individuals. Maybe it's a trusted advisor. The one recommendation and something we put in our documents is that they have to be a fiduciary, a licensed CPA, attorney, or trust company. If you're going to have somebody that's not part of your family or that you specifically choose, it's going to be one of those 3 things. And generally speaking, I really like having a trust department in a bank that does this stuff all day long anyway, being the ones that manage the trust. It's a pain for them. It's supposed to be a little bit of a pain for your beneficiaries because that's how you preserve the estate. If all you did, like again, I'm a beneficiary and I'm a trustee. Hey, I need some money. Okay, here's some money, right? Hey, I think a reasonable car is a Lamborghini. Could I take the money out? If I am the trustee and the beneficiary, yeah, I'm probably just going to give myself the cash. That's why you don't want the beneficiary, especially if it's your kids, to be in full control as a trustee. So you may have a situation where you say, my children and a fiduciary, or my children and the bank department of such and such bank. Now, here's the rub. No matter who you choose, the beneficiaries can fire them. The beneficiaries of a trust document can generally get together and fire a trustee, but when they appoint a new one, that's why you make sure that it's specific, a licensed fiduciary. So it can't be somebody that's under there, like they can't, hey, I'm going to hire Uncle Ned. And why? Because Uncle Ned's a drunk and he does anything I ask. Or, hey, I'm going to fire the corporate fiduciary and I'm going to hire, my kid's sister. No, none of that. You're going to make sure that it's a fiduciary. And why do we do that? Because that in most states, it's licensed. So you can always take their license. And B, because if it's like a bank or a trustee, a professional trustee, they have bonding requirements and insurance requirements so that we know we can go after them. If it's a licensed professional, you can always go after their license. So they tend to, A, not do anything that's too crazy. B, they're not going to risk their license on behalf of some beneficiary. They're going to be pretty conservative. And you can leave instructions and you could say here when not to be so that they can follow it. But there's rules in every state that these folks have to follow about what's reasonable, what's unreasonable. You could say, hey, I want my businesses to continue to run. Here's someone to run this business. And you could still do that and give them direction. Even from the grave, you can. You could say, hey, if a family member and they're good at this thing and they want to work in the business, they get the right to work in the business, subject to reasonable conditions as far as not being on drugs or alcohol or otherwise at a disadvantage, mental disadvantage, things like that. So that there's a trustee that has the ability to step in when necessary and protect the estate, but otherwise it's still operating on its own. So that comes in to the determining who a trustee is. And again, my personal preference is that you work with professional trustees. Even if you list somebody like, hey, I have a brother or a sister and I have kids, and especially if I have minor kids, I don't want those minor kids ever being in a position where they have to manage the estate. I'm going to have my brother, and I might say, hey, my brother and this in a professional trustee. I may even name the trustee. I may interview and talk to my bank and see whether they have a trust department and get comfortable with somebody. This is what I do, and this is why I do it. so that you have somebody there who understands what your wishes were and are, so that they can make sure that it's put into place when the time is right. It's going to happen to us all, so you may as well do that. All right, so that is dealing with trustees. All right, number 9 is charitable planning. Whenever we talk about trusts, whenever we talk about the different choices, when you start talking about trustees, so we talked about trustees, and then we hit the charitable side. You got to be looking at the charitable side, as some of those things might go like this together. So you might have a charitable remainder trust, for example. You may have a family foundation or your own charity that you've set up or that you like to sponsor, or you may sit on the board of a charity, or you may just have a favorite charity. And you may say during your lifetime, hey, there's certain highly appreciated assets. I don't want to pay tax on it right away. I want to spread it out over 20 years. I put it in that charitable trust, but in the remainder interest is going to go to that charity. And if something happens to me, it goes into that charity. Okay, so I'm getting a tax benefit of that gift of its future value. That's going to go to the charity. Usually it's between 10 and 30% of the value. I'm getting an income stream under a charitable remainder trust during my lifetime. For 20 years, I might get an annuity, charitable remainder annuity trust, something like that. Maybe that's what I'm putting in place, but it's working with the charity. The other side to this is I might just set up a charity. I might set up either a private foundation, which is certainly appropriate. I can take a salary out of it. My wife or my spouse could take a salary out of it. I could have my kids on the board. They could take a salary out of it. And all it's doing is managing money, so doing investments and giving money away. 5% of the fair market value of those assets every year to qualified 501c3s. So you can certainly do that. You could be a little more aggressive and say, hey, I actually want to do something. So for example, residential assisted living, veterans housing, single mom housing, low income housing, Section 8, all of those are charitable activities. Maybe I set up and I say, really what I want is my estate to be comprised of a lot of real estate, single family real estate, duplexes, apartments, things like that. But the majority of it is really going to be towards Joe Public, regular old people, and regular people would qualify it under Section 8. So maybe that's what I'm doing. Even, again, it doesn't have to all be Section 8. There's a percentage, there's a revenue procedure that covers it. It's usually about 70% of the rents or the revenue have to be derived from the folks that would qualify or be in a special class. So again, veterans, single moms, neuro, like autistic, elderly, transitional housing for inmates, you name it. If you're doing public good, if you're doing something that's benefit for society, generally speaking, it's going to qualify as a charity. And then I could just give assets to that charity. I can literally just write it a check. I could transfer appreciated assets. Like if I take a house and I transfer it into the trust or into the charity, excuse me, and I take let's say a piece of rental property I've had for 25 years, I move it over to the charity, I get a deduction on its fair market value. Now, there are some limitations as to how much I can deduct. In that particular case, it's 30% of your adjusted gross income, and you carry forward any unused parts of that gift 5 years. But if I paid $100,000 for a property and now it's worth $400,000, and I've had it for 25 years, I get a $400,000 deduction. My deduction is worth more than what I paid for that property. And now it's in a charitable organization. It's not part of my estate. If I die, it doesn't matter. It's still in there. If I'm alive, it doesn't matter. It's still in there. I could be taking a salary, or I could say, don't pay me a salary. My kids could be sitting on that board, and they continue to manage those estates. The charity can be as big as you want, and it's never going to be taxable. If you are doing its charitable activity, you could grow that thing to $100 million. It's still not taxable. The only thing that becomes taxable to you is any income that you're taking out. So if you're paying yourself, so like let's say that we're down the road 2 or 3 generations and that thing's really blown up. By the way, Hershey's is a great example. It's worth over $13 billion now, and started off at a few million back in 1905 when he set it up. Milton Hershey set it up. These things tend to just grow. Or you talk about the endowments at Yale and Harvard. Those things are actually charitable institutions, and it's exempt. So you're investing it, not taxable. So if I'm taking the money out, I could have some wages. Otherwise, that thing's just continuing to grow, and time value of money goes. So I could be contributing directly to things that I care about. I could also be giving a part of my estate. Hey, I pass away, 50% goes to my charity, right? And then I want my kids to work for my charity or things like that. Like you can do multiple things as part of your estate. Hey, here's some money. Here's health, education, maintenance, and support. Plus, here's a job if you want it, and you can do some good. And here's what we cared about. Now, there are annual gifts that you can give that do not work against your lifetime exclusion, that federal exclusion for your estate. It's the same amount for gifts, with the exception of if I give away, right now it's $16,000 a year, but there's an annual gift exclusion, and it's per recipient. So I could give money if I had 3 kids, 16,000, 16,000, 16,000. I don't have to report anything. It doesn't work against my exclusion. I just have found that that's not a big enough bang for the buck if you're a high net worth person. So I tend to look and say, how do we get a bigger chunk out of your estate? How do we make sure that we don't run across a situation where we're going to get hit with estate taxes? If you're over the $20 million mark, you're in $30 and $40 million of value, $50 million of value, you're going to get hit very hard. Let's just say the difference between 20 and 30, you're talking about $3.5 to $4 million of tax as we sit right now if you passed away with that much value. And it's not the liquidated value, it's what its fair market value is when you pass. So it could be a bit of a problem. So the way that you get around that is getting things out of your estate. We talked about a couple with irrevocable trusts. We could also talk about family foundations or active charities, getting them away from you. I am no longer the owner. It's no longer part of my estate. It's in something that is considered separate from me. I gifted those assets in there, or I sold them in there. If it's appropriate, I'm allowed to do it. And that money or those assets are now outside of my estate and nicely protected and insulated. And there's still an income stream going in there. Now, I'm going to say one last thing before I conclude this section, and I'm going to introduce you a little bit to what's going to happen in part 3. But I'm going to say this, is that towards the end of your life, a lot of times what happens, you'll be approached by, planners who have good intentions. And they'll say, let's gift things to your kids. And I'm just going to be the one to say that one of the best benefits of passing away with a capital asset is what's called a step up in basis. So if the year before I pass away, give, let's say, a bunch of stock or a house, whatever the case, either one, it's worth $1 million and my basis was $100,000. I've had it for a long time. $900,000 worth of gain. If I gift it to my child before I pass away, they now own it. It's theirs. It's not mine anymore. I have no control over it. But they get my basis. If they sell that property or that stock, they would have $900,000 of gain. Even after I passed away. Let's say that after I pass, they needed money, they felt bad, whatever, and they sold an asset, and it's $1 million and it has a basis of $100,000. They're paying tax on $900,000 of capital gain, which, depending on the state you're in, could be pretty high. Even at long-term capital gains rates, it's 20% plus 3.8 net investment income tax plus your state income tax. Like in California, what would that be? You'd be looking at about 36.8%, close to 37%. Ouch. Smack right in the kisser. Versus if I just wait and I pass away during my lifetime, and even if I borrowed the money and gifted it to the kid, right? Instead of just giving them the asset. If I pass away and they have to sell that asset for $1 million after I'm dead, they would pay 0 capital gains. I just saved myself $300,000 or $400,000 simply by not doing the gift during my lifetime, but maybe borrowing money, gifting, but not selling the asset, not transferring the asset to them. So again, same scenario. I'm trying to get wealth to my children, or I'm trying to get something out of my estate. It's time to talk to a planner to make sure that you're doing it in the most appropriate manner so that you don't get blindsided by taxes, or you don't create a liability that was unexpected to the client. So I'll give you an example. I had clients, it was actually siblings, and they inherited a building. Dad gave it to them before they passed away because he had an advisor saying, I'm worried about the estate tax. It's going to come back. It's going to be $1 million. You're going to get torn apart in taxes. This building is worth, let's just say it's $10 million. You're going to get killed in taxes because you have almost no basis. The taxes are going to be 30% plus, and 40% of it's the estate tax. Why don't we just give it to the kids during your lifetime? We'll use up your lifetime exclusion. We'll give away $10 million each. Now all the kids have this building. What they didn't realize is that step up in basis on the 10 million would have meant zero tax if they had just waited and let dad pass away and the kids inherited that asset. If that's all they wanted, hey kids, I want you to get this asset. Fantastic. Then 10 million would have had zero tax liability. But because of the way they did it, when the kids sold that, the tax liability was over $2.5 million. Just because a well-intentioned planner told them to do that. So I'm just going to say, put the brakes on. You want to make sure that you are talking with a planner before you do those things. And because you have a trust and because you have a legacy plan, there's no reason to do it ahead of time. It's all set up. All you have to do is pass away. And there is a great adage. It's called the buy, borrow, die strategy, which is what the ultra rich tend to use. Is they buy assets, let them appreciate. Rather than sell those assets or gift them away to their kids, they borrow against those assets and they have the cash. If you want to give that to your kids, go for it. But you're borrowing against the asset. And then when you pass away, the basis steps up on those assets. So at a minimum, you're avoiding all the long-term capital gains. At a maximum, you're probably minimizing and avoiding all tax, and you got a bunch of cash in your hands during your lifetime. That's what we tend to like. It's kind of a two for one. All right, that's the end of part 2, things to do while you're alive. Part 3 will be what happens when I pass. What happens when I pass? And that'll be part 3. So we've gone over, I think we're at 9 steps. So we have 2 more. So that's a trick. When we go over part 3, there'll be the 2 last steps, the big ones. And we'll kind of explain how that lays out. Now, if you like this type of content, please click that like button. Please subscribe. And better yet, if you want these things to be notified when we put out new content, click that little bell. If you know anybody that could benefit from this information, please share it. And then here's a secret. Down in that comment area, if you have topics you want us to cover, that's where we get our ideas. So if you put something down there, A, we'll answer it. B, if it's hey, I would like you to talk about this topic or this issue or whatever, that's what we'll use to make additional comment and content for you in the future. So we'll see you back here for part 3.